Welcome to Voich Daily Finance, the most important news personalized for you every day. Supported by Voich.com.
After listening to today's news, you'll know first $10 billion U.S Taiwan arms deal triggers Chinese sanctions targeting Boeing in a calculated economic warning shot. So we'll discuss why this pits U.S policy against China's red line and what it means for defense stocks and China exposed assets. Second $310 billion annual climate adaptation gap creates a 92% funding shortfall, fueling sovereign debt risks and uninsurable zones. We'll explore how this shortfall creates climate resilience inflation and a new state-led capex cycle for engineering and construction sectors. Third, UK's top union chief challenges the PM over a 37% Brexit premium on food, demanding a customs union policy pivot. We'll examine how this internal political battle could force a major policy shift impacting the British pound and UK China trade relations. A record-breaking $10 billion arms deal is sending shockwaves through global markets, triggering a direct economic confrontation between two world powers. The package, approved by the Trump administration, is the largest weapons sale in the history of the US-Taiwan bilateral relationship. It includes advanced hardware like medium-range missiles and drones, intended to bolster Taiwan's defensive capabilities. The US State Department stated the sale serves American national, economic, and security interests by supporting what it calls a credible defensive capability in the region. Beijing's response was swift and severe. China has officially sanctioned 20 major US defense companies, including giants like Boeing and Northrop Grumman Systems Corporation. These measures freeze any assets the companies hold in China and completely bar Chinese organizations from doing any business with them. 10 individuals, including senior executives, are now also banned from entering the country. However, if you zoom out, you'll see another layer of strategy at play. For most of these specialized defense firms, the direct financial impact of these sanctions is actually quite limited. Companies like Northrop Grumman, after all, have minimal direct business or sales in China to begin with. So from a purely financial perspective, these sanctions are largely symbolic, but don't mistake symbolic for insignificant. The inclusion of a company like Boeing is a calculated warning shot. While the sanctions hit Boeing's defense division, the real message is likely aimed at its far larger and more vulnerable commercial aviation business, which sees China as a massive market. This highlights the vulnerability of diversified American companies to geopolitical crossfire, threatening a key US export category. It's a classic example of using economic leverage to send a political signal. This all centers on what China has declared its ultimate diplomatic boundary. A Chinese foreign ministry spokesperson delivered a stark warning stating, "The Taiwan issue is the core of China's core interests and the first red line that cannot be crossed in China-US relations." The spokesperson urged the US to cease what it called dangerous efforts to arm the island. This creates a direct clash. The United States is bound by its own law to provide Taiwan with the means to defend itself, a policy that is a persistent source of friction. The move pits a historic multi-billion-dollar defense package backed by US law directly against Beijing's most sensitive diplomatic boundary, escalating economic and geopolitical tensions between the two superpowers. So, for global investors, this escalation is likely to force a repricing of assets that have high exposure to China-related risk. Essentially, investors may now demand a higher risk premium for holding Chinese stocks or the stocks of multinational companies that rely heavily on the region. This could impact global capital flows and valuations. You know, the higher the perceived risk, the lower the price investors are willing to pay for an asset. What we should be watching for next is how this strain on the US defense industrial base plays out. The need to arm Taiwan in parallel with supporting allies like Ukraine is a leading indicator for a multi-year spending cycle to expand production capacity for things like advanced missiles. This signals a long-term structural tailwind for defense contractors and their suppliers. The key focal point will be announcements about expanding production lines and future US defense budgets, which will tell us the scale of this new cycle. From the geopolitical friction we just discussed, we're shifting to another source of global instability, and this one is driven by the climate. Let's start with a single statistic that might just change your entire perspective on this crisis. Developing countries will need more than $310 billion annually by 2035 just to adapt to extreme weather. The amount of funding they actually received in 2023, just $26 billion. That's not a rounding error. It's a 92% funding shortfall for global survival. On a macroeconomic level, this funding gap is a powerful leading indicator of future sovereign debt crises. When a country is repeatedly hit by climate disasters, it has to borrow money just to recover, which crowds out productive investments in education, technology, and industry. The United Nations Environment Programme's latest data confirms this trend, showing that adaptation finance flows are now 12 to 14 times less than what is needed. This is creating a debt trap where nations could default not because of traditional economic mismanagement, but because of climate liabilities. And the need is accelerating at a stunning rate. New data shows that the climate crisis made recent scorching wildfire weather in Spain and Portugal 40 times more likely. A heat wave in England, 100 times more likely. Believe it or not, the science of climate attribution has become so precise that insurers can calculate exactly how much climate change increases risk for a specific location. The direct consequence is that insurance companies are rapidly repricing their coverage. Reinsurance rates have already jumped 15% in Florida and 12% in California. This is creating what experts call uninsurability thresholds, where entire zones become too risky to insure at any price, a direct threat to real estate values and household wealth. What really brought this to a head was the recent COP30 climate conference. A new adaptation budget was announced, tripling to $120 billion a year, but there's a catch. The deadline was pushed back to 2035, and a confidential look at the deal shows there is still no clear mechanism to make rich countries pay up. This failure to fund is opening the door to major geopolitical shifts. While Western nations struggle to meet their pledges, other players are stepping in. For Chinese-speaking audiences, this is a key trend to watch. Research from the Center for Global Development shows that China has provided billions in climate-related finance through its Belt and Road Initiative, often targeting the very nations left behind by traditional aid. This is effectively turning climate finance into a new arena for strategic competition. This is where the situation takes a more complex turn, exposing a fundamental breakdown in market logic. The long-term, low-profit investments needed to build seawalls and secure infrastructure are not attractive to private finance. In fact, as climate risk rises, private capital is retreating, leaving the state to cover the risk. Analysts are now pointing out that heavily indebted countries are becoming trapped, forced to spend disaster relief money instead of investing in future-proofing their economies. The situation presents a fascinating duality. On one side, for companies that must protect their global operations, we're seeing the rise of climate resilience inflation. They are spending billions to diversify their supply chains and harden their infrastructure, passing these costs on to consumers and creating a new source of inflation for central banks to worry about. On the other side, as private capital retreats from big public projects, a new state-led adaptation capex cycle is emerging. This government spending on things like seawalls and resilient power grids will become a major driver of demand for the engineering, construction, and materials sectors. This isn't just about vulnerable nations. A group of UK scientists recently held a national emergency briefing, warning of alarming underpreparedness even in wealthy countries. The world is facing a survival question that emissions cuts alone cannot solve. The focus is shifting from decarbonisation plans to national adaptation plans, which demand real finance and real action. The battle is no longer just about the climate. It's about who pays for survival, and right now, the ledger shows a catastrophic deficit. Speaking of the internal pressures wealthy nations are facing, a major political battle is brewing in the UK, centred on the economic fallout from its biggest policy decision in a generation. The most unexpected news in the UK political world today has to be this. The head of the Trades Union Congress, Paul Nowak, representing over 5 million workers, just went on the record with a direct challenge to Prime Minister Sir Keir Starmer's core economic policy. Nowak is publicly telling Starmer to abandon his hardline stance and consider rejoining a customs union with the European Union, a direct contradiction of Labor's own manifesto. Now, to understand the gravity of this, a customs union is not the same as full EU membership. It mainly means removing all tariffs on goods traded between members and applying a common tariff to all goods imported from outside the bloc. This is distinct from the EU's single market, which is much deeper and also includes the free movement of people, services and capital. So what Nowak is proposing is a significant step back toward European economic integration, but not a full return. It would force a fundamental shift in the UK's entire economic model, away from striking independent global trade deals and back toward Europe. Nowak's message is blunt. He told the BBC, one of the reasons we are seeing prices so high in our supermarkets is because of that bad Brexit deal. And there's hard data to back him up. Researchers call it the Brexit Premium. Since January 2020, UK food and non-alcoholic drink prices have soared by an astonishing 37%. By comparison, overall prices in the UK rose by 28% in the same period. Interestingly enough, during this time, food inflation in the Eurozone has been much more controlled and is expected to stabilise around just 2.5% next year. This gap strongly suggests that post-Brexit trade frictions are a key driver of the UK's cost of living crisis. He then declared the government should rule nothing out and look at every option, up to and including a customs union. This isn't just an outside opinion, it's a high-stakes demand from a crucial political ally. But that's not the whole picture. The real turning point is the pressure also coming from inside the Prime Minister's own party. 13 Labor MPs recently broke ranks to back a bill pushing for a new customs union. Senior cabinet ministers have also been openly bemoaning the economic damage of Brexit, dancing right up to the edge of the party's official red lines. For the markets, this growing political pressure is a leading indicator of a potential major policy pivot. If the UK government softens its stance, it could lead to a fundamental repricing of UK assets. For instance, reduced trade uncertainty could strengthen the British pound, and sectors that rely heavily on EU trade, like automotive and manufacturing, might see their stock values rise. This economic pain is fueling a political crisis, with Nowak warning that financially insecure voters are abandoning Labor. He argues that failing to deliver on living standards will just push more people to political rivals, stating bluntly, I don't think you can out-reform reform. And that brings us to another layer here with huge implications, especially for China. If the UK were to rejoin the EU customs union, it would also have to align with the EU's trade defence policies. This includes adopting the EU's common tariffs on imports from non-EU countries, such as the proposed tariffs on Chinese electric vehicles. This would fundamentally change the UK's geopolitical positioning, shifting it from an independent competitor for Chinese investment to a protected partner within the EU's trade bloc. This isn't just a policy debate, it's a warning about political survival. Nowak's message to the government is that if it cannot deliver tangible economic improvement, faith in mainstream politics itself could drain away. We'll need to watch for any official response from the Prime Minister's office, as any hint of a policy shift could move markets. The key indicator to follow will be the UK's inflation data, especially that food price gap with the EU. This internal political battle is now a critical focal point for the UK's economic future.
That's it for today on Voice Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.